Thanks a lot for agreeing to be interviewed. Can you please tell our audience a little bit about yourself, your family, and your professional life?
Sure. So I'm a third generation CPA. My grandfather, my father, myself, and actually my wife's father as well. So,
Wow.
yeah, a lot of accounting in the family. Started my career at my dad's accounting firm, but left after about a decade after becoming a partner to start my own family office. And my wife and I have been married for just now 20 years, and we met when we were teenagers. And we've got two young children that are still in grade school. We live in South Florida, although I was born and raised in New Jersey.
Jersey.
Yeah.
Excellent. Very nice. Very nice to meet you. What made you move to Florida?
Just the weather. When we had our first child, our son, I had moved into the family office business. We would spend a couple of weeks during the winter in Florida, and we really loved it. And my grandfather was here, my father's father. I enjoyed spending time with him. My in-laws had a place at the beach that we could stay at. So it's just a nice, relaxing way to enjoy part of the winter and get away from the snow. And when we looked at each other, my wife and I, one day walking on the boardwalk after we had bought a lottery ticket, and we said, if we won, we'd move here. And part of our philosophy has always been to do what we would do if we would win the lottery, but just do it without winning the lottery. So that's motivated us to get down here as soon as
Sure.
we
Just
could.
just like the song goes, right? If I were a rich man.
Right. Exactly.
Yeah, you mentioned the topic that we were going to cover today, family office. You said you started out family office. Can you define for our audience what family office is?
Yeah, I guess there's no, the definition's been somewhat bastardized over the last decade. So historically, family offices were created by families that had significant wealth to manage their own money, and they'd hire their own team to build their own family office just to manage their own family's money. What happened over time is the same way we had this evolution away from stockbrokers to financial advisors. That evolution continued from financial advisors to becoming called wealth managers. And now you have essentially a lot of wealth managers that are becoming family office advisors. I've kind of grown up that way. So I used to distinguish myself from financial advisors by being a wealth manager. Now I distinguish myself from being a wealth manager as being a family office advisor. What that really means is that we're managing the total balance sheet for affluent families. So our business is a multi-family office, some would call it, which is not dissimilar to a wealth management firm. I think the main distinction, at least from us, for what we're doing is that we're looking at the total balance sheet. So we're not necessarily taking a position where we're only getting paid on stocks and bonds that we're directly managing, which is really what most wealth management firms derive the vast majority of their compensation from. As a family office, we're really focused on how do we advise a family around all things related to their wealth, and how do we charge them a fee that compensates both of us fairly for the effort and the results that we derive.
Excellent. And to expand on that definition, would you say that wealth advisors primarily work with the person that engages with them, where family office concentrates more on the family overall? If the person who engages with you has maybe children or plans to leave a legacy in some sort of way, do you expand on that, and do you cover those other areas as well?
It depends on who's hiring us and what their goals are. So a lot of our new clients come to us when they're thinking about selling their business. And
Mhm.
oftentimes those entrepreneurs are in their 40s, 50s, or 60s. And depending on where they're at in their life spectrum and how old their kids are, it may or may not be that relevant to help with the family education around money. Uh, what we find is that usually as the demographics of our clients get older and they start to have grandchildren, now there's a reason for us to be interacting with their children who are maybe in their late 20s, early 30s, who are building families of their own, starting to educate them about money, not just the money that maybe mom and dad are going to leave to them, but also the money that they're earning themselves, how to protect themselves from taxes, from creditors, asset protection, and then also, if something were to happen to them, what would they want to happen for their children?
Sure. So essentially, correct me if I'm wrong, but family office entails all financial aspects. So it's managing their balance sheet, doing tax compliance, tax strategy for them, and then helping them to not only invest their funds in Wall Street, but also be able to diversify beyond Wall Street into other financial vehicles that may or definitely not available through the typical wealth managers that simply concentrate on Wall Street stuff.
That, and I'd add to that, especially for the clients that we deal with. So most of our clients are entrepreneurs. They're creators. They've created value through the building of a business, and our focus for them is figuring out how to maximize the value of that company, whether they want to own it or they want to transfer it. So we don't necessarily only deal with entrepreneurs after they've sold and they've got a big pile of cash that they need to put into Wall Street products like stocks and bonds. We're working with clients where the vast majority of their wealth might still be tied up in their business. And just because it's in a business doesn't mean they don't need advice around how to properly manage it. And the same is true of private equity investments that they may come across that we're not sourcing directly for them. So a lot of our clients have a great network of friends, colleagues that are doing other amazing things in their businesses. And sometimes they're looking for capital, and we're helping them decide what to allocate to, how much to allocate, and how to manage those investments as well.
Interesting. So, in a way, it becomes sort of a club, if you will, maybe not officially, but unofficially, where people can bring their potential investment ideas and have you and your team help them to research and do due diligence and advice on those investment ideas.
Yeah, so we
Correct?
just had a prospective client the other day who's sold a medical device technology business and
Mhm.
has been thinking about getting into another medical device business. And what we showed him is that if he works with our firm, how he could structure um, his investment, not just to invest his own capital that he could get a return on, but also how to aggregate capital from other people that already trust him, and potentially from other families that we work with, where he could raise additional capital, make money for syndicating and putting that deal together and overseeing an investment. So he could leverage not just the opportunity that he sees in front of him, but it also leverages his time so that if he does help produce results for that investment, he'll receive rewards, not just on his own money, but on the money that he's able to raise behind him.
Excellent. Wow, that's a great idea. Love that. Now, a lot of our audience are investing in syndications, in real estate syndications. So a lot of them are familiar with um, real estate investments. Curious, is real estate one of the vehicles, investment vehicles you offer to your clients? And if so, how often do you offer it? Is that more common than, let's say, other investments outside of real estate?
Yeah, I like to think of my family as a real estate family. So we own interest in 3,500 different apartment units around the country and a 500,000 square feet of retail and office space. We've done 33 transactions, and that's how I like to invest most of my liquid wealth. I believe it's super efficient. It's got a great risk profile, and so I'm sourcing deals for my family, and then I'm bringing in other families with us. Our platform for that is called Invest with Our Family, because that's essentially what people are doing. We closed on about 1,000 doors this past 12 months. We'll probably close on another 1,000 doors in the next 12 months. Usually that's broken up between anywhere from 4 to 8 deals. And we'll work with new investors that want to invest with our family just in one real estate project as a way to build the relationship. They don't have to be a family office client. Not everyone that wants to invest in real estate really has the need for the full family office services that we provide. But then all of our family office clients typically want access to the real estate investments that we're making.
Sure, sure. You mentioned that one of your real estate investments um, is offices. Do you still believe in the office space? Do you think it has the future?
No, we bought our office buildings early in the cycle. So we've got a 200,000 square foot building out in Oak Brook, Illinois, that We acquired in 2012 at a discount to the note value. So we basically took it over from a bank, and there was a lot of built-in equity when we took over that acquisition. We've gotten 70% of our money out of it already over the course of the last 8 years. And there were some risks in that deal that were unique to it. We had a single tenant in Comcast. We were trying to figure out if they would renew their lease. If they did, it would be a home run. If they didn't, maybe it would be a single or double. So they ended up renewing 2 floors, not all 3 floors. And, we're working on re-tenanting it. It's a great location. It's a great suburb. It's a good asset. I don't know that it'll ever be worthless, and I don't know that we'd ever lose our equity. But the play when we went in was that just based on the existing lease term and the purchase price, we were going to get out the vast majority of our money just from cash flow. So even if at the end of the day, the business was worthless and we had to give the keys back to the bank, we really weren't going to lose that much money. We've got 2 other office buildings that we bought with similar stories, unique situations where we felt like from a risk reward standpoint, our capital was pretty secure, and it was early in the cycle. I would say by 2014, we didn't acquire any more office space. The pandemic has certainly shown what sensitivity there is in the office space environment, and I'm glad I haven't been allocating to there for the last 6 years, and I don't foresee allocating in the future.
Got it. Yeah, makes sense. Makes sense. And going forward, you said you think you're going to acquire another 1,000 doors this year and so forth moving forward. What type of real estate investment would be on your horizon, knowing the situation that it is today? We're in a time where we're expecting presidential elections to happen. We don't have a vaccine for COVID. We don't know how the economy is going to turn out down the road. So the economy is more or less unstable these days. So how do you proceed in selecting your next real estate asset class?
So we've been heavily allocating to what's been commonly referred to as workforce housing. So assets that are essentially C-class assets. Sometimes they might be in a B- neighborhood, or maybe we're buying a B- asset in a C neighborhood. But usually we're buying assets that are built in the 60s, 70s, or 80s. They have a need for improvements. They're places that most of our investors would never want their kids to live. But what we do is we go in, we buy them with as high loan to cost financing as we could get. That's part of our model that we believe in with low interest rates that we have today. We go in and we rehab them, we re-tenant them, and then we refinance them. And we refer to that as our infinite return model, because typically if we execute well, we're able to put in our capital for the closing within 12 months, maybe even 18 months at the long side. We're getting the vast majority of our capital back directly, and then indirectly through the tax benefits. So we basically recoup all of our capital. We still own the asset. We still get cash flow. So that's really the playbook that we've been using for a number of years that I've gotten very comfortable with in today's interest rate environment. I think, the playbooks change over time based on what's happening in the marketplace. Right now, we're recording this in the fall of 2020. And going into this winter, I think there's some uncertainty as to what rent collections might be. The stimulus has run out. A lot of our tenants are in that $30,000 to $60,000 a year income range. So some of them have been displaced by COVID. We're kind of above the restaurant and retail worker level, but below the kind of white collar workers that are working remotely pretty effectively. So a lot of nurses and managers and mid-level people. We believe that there's a chance that in the assets that we own or the assets that we acquire, we're going to take a hit in the winter with our rent collections. But the flip side to that is that there's a lot of capital that's leaving the northern New England states, that's leaving California because of the fear of the tax rates, because of the fear of the policies that they're implementing and on the workers, and that capital is flighting to the markets that we like exposure in, which is mostly the Sun Belt states and the low tax states. So I think the cap rate compression that we might see over the next 6 months to 12 months is going to more than make up for any of the cash that we miss out on collecting in that same time frame.
Yeah, no, that's an excellent strategy. I love it. I love it. That's amazing. And what would you say are your main goals when it comes to investing in syndication? Would it be more of capital preservation, or is it something else?
No, so I tend to be a higher risk investor in the real estate investments that we like to make. I think
Mhm.
there's, luck favors the bold or fortune favors the bold, whatever that term is. I'm young, not all of my clients have the same risk profile as me, but for my family, we've got more cash flow than we need to pay our lifestyle expenses. So we can take risks that other families can't afford to take. And by producing these, syndicated investments that have very high loan to cost financing, we really reduce the amount of equity that's required to get a deal closed. So we just bought a 475 unit asset for $30 million. We only had to put up 3.5 million of equity. So, that's a really skinny equity check to acquire such a large asset.
Yep.
Now, in the worst case scenario, we lose all of our money, right?
Yep.
Uh, Now, that's a risk I'm willing to take because in the kind of best case scenario, based on what we think are some relatively reasonable assumptions, we could probably do 5 or 6x our money in the next 12 months just through, the capital improvement plan, the value add plan, refinancing, getting our money out. So I'm willing to take the risk of loss in exchange for that upside, because if I'm wrong on most of the deals that I'm doing and we're not able to refinance our bridge, we're not able to get up our rent, if we had 20% equity at closing instead of 15 or 10, we probably would be in almost the same position. So I think, at least in my mind, I could always inject that additional equity after the fact if I feel like it's a good bet. But I can't get that equity out if it was a bad bet. So I might as well go into the deal with as little equity as possible. And then if we need to rescue it for whatever reason, we have that option. And if we want to walk away, we know exactly what our loss is.
Excellent. You mentioned that because you're young, your investment profile is probably a little bit riskier than some of your clients who might be older and are not willing to take as much risk. So when you're advising them, um, do you still offer them this kind of investment, or do you tend to keep them towards less riskier, more stabilized type of real estate investment?
So a lot of times they'll make an allocation to every deal that we do. It's their allocation might be different than mine.
I
So,
see.
they might have twice as much money as me, but they're investing half as much.
Sure.
Uh, right.
Yeah.
And so that's because they do have a fixed income portfolio, whereas I don't have any fixed income. I don't believe in fixed income for someone like me.
Yep.
I have a private debt fund. So a lot of times, I'm making investments in private debt that are certainly much more conservative from a risk standpoint. A lot of that is actually mezzanine debt or preferred equity in real estate deals, where we're taking a different portion of the capital stack. So somebody's acquiring a multifamily property, they're getting an agency loan, maybe it's 65 or 75% loan to value. We'll come in with some additional money on top of that in a preferred equity position where our total return is going to be capped at 12 or 14%, but we're getting a current pay of, anywhere from 8 to 10. And, we're protected by that other 15 or 20% of equity that's coming in behind us. I'm really comfortable with those investments. Again, my clients may have more exposure to that than me, because while I like that risk profile, I still would rather be on the equity side of that deal.
Sure. Sure. Makes sense. Excellent. Love it. So now, what does it take someone to build a family office?
So I think there's two ways to answer the question. One is, if you're an entrepreneur that, has built a really successful business and you now want to find a way to manage your money the same way you've grown your company by building your own team, putting people together that are smarter than you, can have expertise that's greater than you, usually you're going to look at probably a minimum budget of $1 million a year to run that family office. So you have to decide what's the delta that you need to get in returns to make up for that cost, or do you value the control enough to pay the $1 million of fees to build your own team? and that's really on the low end. If the question is really geared towards, hey, I'm a wealth manager, I have a couple of clients that have, 5 million, 10 million, $20 million. Should I try and move up market to a family office? It's a little bit of a different question. I think it really depends on who you like to work with, what you like to do for them, where does your passion lie? And, do you really enjoy the total balance sheet for a family, and some of that off balance sheet stuff, which is interacting with the kids, coming up with the estate planning strategies, the family conversations around money, the more holistic, approach to how is a family going to utilize their wealth over generations and incorporate philanthropy. And there's some broader discussions that are outside of analyzing an investment portfolio.
Makes sense. Makes sense. Yeah. And, in addition to having that profile, you have to have the skill set. And if you don't have the necessary skill set, you'd need to find and hire the right team members that will work with you in family office. And it sounds like it's rather unique skill set, as the person has to be approachable, easygoing, social, and be able to work with the family members. And by the same token, they have to have the expertise necessary to offer the right advice to the family.
Yeah.
So yeah, absolutely. We're coming up to the end of our interview, and we typically like to end with asking our interviewees this question: if you were to look back in time when you were starting out, what would you recommend to your younger self? In other words, what would you do differently if you were starting out again, knowing everything that you know today?
Yeah. I probably would have gotten started with real estate syndication sooner. So my wife and I bought our first two-family house in 2000, 20 years ago, when we were first getting married, and we lived in half and we rented half. And then, a couple years later, we took out our equity and we bought another two-family house and we rented that. And then a couple years later, we took out the equity and we did it again. And the plan was for me to acquire 20 units and, build my career in accounting, own 20 units of multifamily housing, pay off the mortgages as we were working, and then I'd retire on, 20 units worth of rental income. And I think that was a great plan, but it wasn't a great plan for me. And really, my plan should have started with real estate syndication. It's much better suited to my skills. And I ended up getting started in syndication around 2011, 2012. So I would have had 12 more years of experience in syndication. And I think that was a missed opportunity.
Have you heard of real estate syndications in 2000 when you started out with the duplex?
Yeah, I mean, so I started out with this real estate concept, in part from the books I was reading, in part from our accounting office clients and the clients that my dad had worked with when I was growing up. And, you kind of knew, like, oh, so-and-so, he's a wealthy guy. He owns a bunch of apartments, and I started seeing, like, oh, a lot of the wealthy guys have apartment buildings. Okay, there must be something to it. But none of them were in the syndication business. So I didn't see it from a professional standpoint, but I just knew of it, but I didn't really connect the dots as to, like, I had a client who was in the syndication business and that's how they became wealthy.
Yeah. And the point I was trying to bring across, I don't think syndications have been as popular as they are today. I think the trend really picked up maybe in the last 5 to 8 years. And before that, it was more or less unknown to the rest of the world. So absolutely. Great. No, this is awesome. Thank you so much again, Noah. This concludes our interview for today. Thank you so much for your input, your feedback. I'm sure our audience appreciate all the knowledge that you shared with them.
Yeah, well, thanks for reaching out to me on LinkedIn and getting me on, and look forward to seeing the results of the interview.
Yeah, no, absolutely.